All right, everyone, how are you doing today? I wanted just to get over and get something off my chest a little bit. Once again, this is just for educational and informational purposes only. You got to do your own research, read the books that I have mentioned in the past. But just kind of just get a little bit off my chest because I have had someone come in here and um, say a few things that I didn't really appreciate. But anyway, if you think that this is it's not for you, that's completely and utterly okay. Um, One second, let me see here. I gotta start the video so you can actually see me. There you go. So I'm once again in my little domain by the furnace here in the furnace room, just so I have some peace. But this is just for educational purposes. There's several things I've shared on Facebook, and people have messaged me in private. I'm not going to share. I'm not going to name names, nothing like that. But they pretty much say that what I'm preaching is not something that should be or talking about it should not be talked about whatsoever. And I just wanted to talk about it a little bit. And of course, this is not going to be accurate information because I'm just going to be using numbers. There are charts that I have on my Facebook page, on my business page, and if you want to see those that have the accuracy, go for it. But yeah, that's all I'm going to say here. And one of the things that I want to talk about is the biggest reason why people think this is a scam is because of the fact that I tell them that they should meet with me every year if they do this. And they think that I'm just trying to sell them more of something, and that's not the case. Okay, so I'm going to get started here quickly. So with a difference between a term and IUL, if it's by a term policy, you don't need to talk to me again until the policy is canceled or you get get a brand new term. And I'm all for getting term to make up the difference in life insurance of a just in case kind of thing. But I made a comment on Facebook saying that an IUL is better than buying term and investing the rest because investment always includes risk, which means there is a big portion of it that's going to have a decline. And I proved myself by showing him the charts and the graphs and everything like that. And he still thought I was just making crap up. He's like, I've never seen an IUL perform that way, this, that, and the other thing. Is like, because no one knows how to do it correctly. So one of the things that I wanted to show you is on here is, let's see if it does. Okay. So now there's two types of insurance. One type is you buy $100,000 or sorry, two types of IUL. This is option A, and option B is over here, right? And the thing is, a lot of people don't realize this. So this is 100K, all right? And while you're doing I'm just using 100K. And then while you are putting your money into it and it's building cash value and everything, you are in a way self-insuring. So you're literally doing this, you're building up to 100K, right? And the insurance side of things always has to be at least 5%, at least 5%. It depends on the company, of course, above your cash value. So if you hit your cash, excuse me, your insurance costs are getting less and less every single year because there's less and less risk to the insurance company, right? So right here, this is all your cash value. So let's say it's paid up. So let's just say up to that 5% mark. And if you keep paying into it, they have to keep raising the death benefit from $100,000 to how do I say it? Let's just say $125,000 because there has to be, because it's an insurance policy, they have to have insurance on it. You've bought and are self-insuring yourself for $100,000, right? All the way up to this point. And then from here to here is, let's just say $25,000. You're only paying for the $25,000 of insurance that what would be cost right now here, right now at your age at that point in time. So if you, let's say you throw $50,000 into the dang thing, right? And then you make up the other $50,000, you're self-insured for $100,000. And since it's an insurance product, they have to have that 5%. I'm just using 25% just for make it easier. So doing this is very awesome. People say you're not doing it. You're getting one or the other, right? Oh, if you die, you either get the cash value or you get the death benefit. What they don't understand is that you have this money and you are self-insuring yourself by your cash value, and they can only the cost of your insurance, which would get less, or because your insurance is getting less, or is your amount of risk to the company is getting less, is you now have $25,000 and you are buying only $25,000 worth if you have, or just to, so it goes from $100,000, let's say it goes down to 20,000, then it goes to 40,000 or 50,000, and it's 75,000. You got $18,000 left, and but then they're going like, all right, we have to keep a minimum of 5% above your cash value. So what you're doing is you're getting your cash value back, plus all your earnings and dividends and whatever else not, plus that little bit of life insurance that's left on your whole life policy. That's why a lot of people don't understand like whole life insurance, is because they think that a whole life policy you get one or the other, when they don't, because they don't understand that you're paying for insurance every single year, and it's going to be the exact same price every single year until you die, because it's stretched out over all those years. And they're like, well, the cost of insurance doesn't get less. It's like, no, it's like a house. You get a mortgage of 30 years, you pay off your mortgage. What happens? You got all those fees and the mortgage, the interest and all that up front end loaded. And then it goes down smaller and smaller and smaller. And the amount you put in there is and your cash value just keeps growing over time, because there's less and less insurance you're paying for, or less interest rate, or less interest that you're paying on an amortized loan. I mean, if you look at your amortized loan, you'll see that if I'm paying $1,000 a month, I'm only putting like $250 towards my principal at first, and the rest goes to interest. And then as you come, and so it's like this, literally looks like this, and then it slowly goes like that. And so it's very little interest rate and a lot of cash that's going into your equity. You just got to put it into a different, okay, in your mind, just to understand this a little bit better. So this is pretty much what you're doing with life insurance. Whole life is like this. It's an asset. It always will be, and it's going to be treated like an asset. And the best way is, because everyone understands mortgages, boom, it's like a mortgage. You're going to be paying a lot for insurance, or your interest rate from top, and a little bit that goes to your cash value. So insurance, cash value. By the time up to a certain point, it's going to be your cash value, and this much goes to your insurance, just like a mortgage, right? Then there's option B. All right. So option B, let's see. So with option B, you're going to have $100,000 of life insurance. This is called increasing. This is level. Sorry, I should be putting that over here. Level. I'm just going to shorthand it, level. And this is increase. So increasing. So you have $100,000 of life insurance, and you can switch back and forth between these all you want. And so if the younger you are, I definitely encourage to start with increasing. Why? Because it's going to be a little bit more off the top, but it is protecting you. And then once you get to a certain point, you can switch back to level. And this is one of the biggest things. So you're always paying for your life insurance, which is here. And then you're paying for your cash value, or putting into your cash value. So that gets added on to here. right? So your cash value is going to go up and 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 up. And it's just going to fill this entire box here, right? Great. Your cash value could end up being $1 million or even $2 million. But then you're still paying the price for $100,000. And this is why you should always meet with the insurance agent if you have a whole life policy or like the IUL permanent policy. If you have an IUL, you want to do this because if you choose one side and then want to switch to the other side, you have to talk to the insurance agent and they can fix it for you. But yeah, so you're going to have $100,000 of life insurance in the entire time that you're growing your cash value. You're just pumping into that. And this increasing helps you put more money into your cash value. How is that possible? Well, because I'm constantly putting in a certain amount. Because if I do this policy, let's see if I can clear this. Let's just do that. So I already explained the level. It's all good. You know, let's just, there you go. All right. So option B, increasing. We are always, come on, there you go. Oh, I want this one. There you go. So we want $100,000 of life insurance. And then we put into the cash value. I'm just doing this. We're having two separate accounts, not one. It's always two separate accounts. That's with the level or the increasing. We always have $100,000 of life insurance over here. And I am paying for this risk. Let's just say it's, I'll just go with $100 a month. I'm essentially buying money for $100,000 for $100 a month. That's actually a pretty dang good deal if you think about it, because you're getting pennies on the 100 grand for pennies on the dollar. It's a bargain no matter what, if you think about it. But anyway, over here is the cash value. Sorry, my whiteboard and my fingers aren't doing so great. So I can keep stacking my cash value, and doesn't matter how much it gets, I'm always going to have $100,000 worth of life insurance. So if I put $25,000 in my cash value, I still have $100,000 of life insurance. Now, the difference between this one and level is that since they're two separate things, if you die, or let's say I die, my family gets this $100,000 of life insurance plus, so my beneficiaries, there you go, is going to end the cash value. That's awesome. So they're getting, I could have $500,000 in here. So $500,000 of cash value goes right to them tax-free. Oh, and then here's $100,000 worth of life insurance tax-free. That's fantastic. So, but up to a point, it's all right. I have $100,000 of life insurance. I'm putting $100,000 or $100 a month into that. Plus, I'm putting, let's say, $300 into my cash value every single month. That would be $3,600 a year. So 3,600 a year. Let's just say 10 years. I should have $36,000 a year after 10 years, plus my interest plus dividends. And everyone's like, wait, what? I mean, I understand. What's going on? Doesn't make any sense, does it? Because we're all taught, especially with the Dave Ramsey people, is that a whole life policy is junk because you get one or the other. And that is absolutely wrong. You get your cash value and whatever's left of the death benefit that's left. So you get $100,000 for, and it's going to be equal to $100,000. When you do increasing, option B, you get cash value plus death benefit. That's what people understand. That's why people, I mean, you say, well, I am a licensed insurance agent, whatever else not. Okay. Do you understand it? Were you taught properly? Probably not. Doesn't matter. And you don't take the time to educate yourself, it is your own fault. Anyway, this is why I just wanted to explain the difference and how it works, because a lot of people do not understand it whatsoever. And I just say, look at life insurance, whole life policies, or even an IUL that's set to option A as a mortgage. You get your cash value is the equity in your home, and that's it. You got a whole bunch of interest and fees and everything on the front end loaded, and so you're paying all the interest down first before you build up that cash value faster. So if you want to build up your cash value faster, you want to use on option B, which is the increasing here. And that will show you, I mean, that will make it so that, hey, I am saving for my future. So this is better than buying term and investing the rest, because I am buying $100,000. I mean, I know $100,000 in life insurance is not $100. I can easily get that for a way less. I'm just using round numbers just so it makes my life easier. Anyway, so I'm paying $100 towards $300,000, or for $100,000, sorry, and I'm putting $300 into my cash value. So I'm putting $400 into my policy every single month, and this separates the two. So it's like, all right, I'm always going to have $100,000, and I'm always going to have my cash value. And if I die, my beneficiary gets both. Make it super sweet, super simple. I hope this was extreme value to you guys, and I will see you in the next video. And I hope that you guys have a fantastic day and fantastic week, and like, comment, share. This is for education. It's not investment advice. It's not anything like that. And I just want to make sure that people understand fully what life insurance is and what it can do for them. Because if you are not properly taught, you will screw up, or you will think it's a scam, or you think whatever Dave Ramsey and his following think, and it's simply not true unless it's set up that way. So anyway, I love you all. Please like, comment, and share just to get the channel out there, and I hope you have a fantastic day.